Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, March 9th. We welcome everyone here today. We got Rachel Dashel with us in the chat. We welcome her. She's been on sabbatical, and so I'll get to that in just a moment. We also got many of you here today. We got such as Will. Hello, Will. Dean with us, Amanda, Bill, Betsy, Kevin, and many others. Welcome to all. Let's go ahead and hop right in. Hopefully you had a great weekend. We're right back at it. Just real quick, as we get started, you could actually follow us. We do stream live on YouTube. And if you go to this page right here, you're going to see that our webcast, our channel on YouTube is called Trader Talk Schwab Coaching Webcast. You can subscribe for free. Now, you could also follow Rachel. If you did not see, Rachel kind of posted a funny video, which, by the way, happens to us all, of her little episode or a little funness in Costa Rica, getting a little car stuck there. And hey, it happens to us all. And I want to hear more. And also, you can follow her there. I'll put her link right there in the chat. And then actually, there's my X page. And so the reason I'm giving you these handles is that we could actually follow us, and you could actually see our educational examples on X and also announcements as well. Last but not least, for this class, this is the playlist for this class. Last week we talked about moving average envelopes, and today we're going to really be hopping into kind of, I want to talk about here today when we kind of have, I'm going to use the language as craziness in the market, falling back on time-proven principles of investing, because craziness doesn't last forever, okay? But what are some of those time-proven principles that you learned that you lean on when there is higher volatility, okay? Now, I do have an advantage, okay? I wish I would have started out where I am now in 1996. I wish, okay? But the biggest actually thing is I have 30 years of experience doing this. I've seen tons of craziness, and I know you have too. But the biggest thing is we know the craziness happens, but the biggest thing is we want to focus on what are those investing principles and applying those over time. That's key. That's what I want to talk about here today. Now, of course, as we do that, we'll talk about technical analysis as well. Now, when we talk about this, remember the information here is provided for general informational purposes only. Also understand that when we talk about examples, they're not individualized recommendations, they're examples. When we talk about stocks, we will also bring up options. Remember that options carry a high level of risk, not suitable for all investors. Understand that options are not all the same, okay? You might consider some and not the others. That's okay. You get to choose for yourself. When we also talk about examples, we will do that on the paper money software application. When we talk about investing involves risk, including loss of principal. Could you imagine if you were short oil last night? Oh, okay, but unbelievable. And we'll talk about a couple charts here right off the bat. So first off, let's bring up where the markets are. We'll kind of talk about kind of some of what I call the quad four that are kind of causing some of that volatility in the market, just briefly. So if we were to, let's say, bring up just real quick, let's go to VIX. Now, remember, I want us to imagine that we're on Miami Beach, okay? And the VIX is a chart of the height of the waves on the beach of Miami, South Beach, that is. Well, last night, the waves, okay, or this morning, I should say, the waves on South Beach got up to 35 feet high. Now, obviously, the higher that the waves are, the more volatility is, the more risk there is, right? Might even actually say on the beach there, no swimming, excessive high tide. It's kind of like that in the stock market, right? So when we get high VIX, there's high volatility between price fluctuation, right? And that's where some investors might say, hey, given where the height of the waves are, I might not be that active on some positions, or at least in the shorter term, because the waves are pretty high. You might be thinking about, if I invest, I want to try to take some positions, dollar cost averaging, betting that in the shorter term, there's probably going to be volatility, but trying to set up trades on an intermediate, longer term basis, okay? Now, what I want to kind of get to is just a couple points that I think are really important. There's a little saying from a gentleman in Nebraska Now, by the way, I'm not against Nebraska, okay? I was born in Lincoln myself in 1977. The gentleman said, when the tide goes out, you find out who's been swimming without a swimsuit. That last was not exactly what he said, but this is a recording, okay? So now, some of the things that I've learned is number one is when the volatility goes up, it really exposes people's allocation. Is there an over allocation to maybe where you only have one or two focuses? Like I'm all tech, I'm all discretionary. The narrower the focus, the more risk there is. Second, are you all short term? Do you have anything intermediate and long term? Third, what about risk management? Do you use stops or do you have stops? Do you use options like long puts or callers? Do you hedge with the S&P 500? Or do you use a future product, something that if the market went down? What I have learned is, though all those are important, what I've learned is setting stops on everything might not be a great idea, because when you have the height of the waves in the market go that high, it has a high probability of hitting all the stops, most likely, triggering them. And it leaves with the investor potentially with zero positions. So some investors might say, I'm not going to set stops on everything because not everything in my portfolio is shorter term in nature. Okay. Now, the biggest also thing is when we talk about, let's say, stocks, is are you investing just in stocks, or do you say, James, I like to buy some sectors, which might be a mixture of stocks, or I like to buy industry groups, which is a mixture of stocks, or I like to buy products that actually are trying to track an index, which is a basket of stocks. These are things that the investor, they have to know. And the last two things I would actually really say is dollar cost averaging. And the other thing with that is using buy stops. If the markets are going down and you have orders, but those orders are not getting filled, the price is not going up in your favor. And being patient and waiting for those setups, okay? Now, James, when you got started, did you do everything right? Absolutely not. The reason why I have this list is because I did every dumb thing underneath the stars, okay? And I learned from my stupidity. The goal is, at the end of the day, is that you have money at the end of all these learning lessons, okay? And that's why taking small positions at first in the paper money account is important, because at the end, after you learn, you want to say, okay, now I get it. Now I'm going to apply principles over time. So welcome to trading today. Let's go ahead and hop right in. So obviously with crude oil here, here's 119. Now I've actually seen, I've watched crude for 30 years. I've never seen the percentage push that we've actually seen. I would say this is a true crash. We see crash downs, but we don't see crash up, okay? And we saw the crash up last night, and the move was pretty amazing. Now remember, we have the quad whammy here. We have VIX going up, crude oil going up. We see the US dollar, people saying, give me cash. And also at the same time here, you have the last one, but not least, the rates actually rising. And so what's kind of interesting about this is TNX CGI. There it is. We've even seen rates go up. So if we said VIX going up, crude oil going up, dollar going up, and rates going up, do you think the equity market's going to go up? I think people would say, are you out of your mind? Okay, probably not. Okay, now when the market goes down, it never feels good. Okay, now let me give you a quick example. In the paper money account, I'm going to hypothetically say that this account started with 40,000. And then I'm going to say that this account went up to 42.5. And then I'm going to say that this account now is at 38.5. Now, when it pulls back off the high, if I started at 40,000, does it hurt my feelings? Yeah, it does hurt my feelings. But the moral of the story is, if we're sitting in bullish positions and the market falls down, it has a bigger percentage drawdown because it actually, for example, is a lower dollar portfolio. Hypothetically, and I literally mean that, if this portfolio had started at 150 and it went up to, let's say, 155,000, and then it comes right back down to 150, it's like we're right back down to where we started. Now, that's a true statement, 155 to 150, that's true. But the biggest thing is it's at 150 when the VIX is at 30 or whatever it is right now. It's at 27. So we haven't really recovered a ton. So if the market just bounced up at all, if they came out with announcements that, by the way, we're not going to be attacking anymore, things like that, can the portfolio probably go up to 152, 153 in that one announcement? Probably. Okay. So you got to understand, like, I'm not investing for just today only. I'm investing for weeks, months, quarters, years. This is how wealthy people, okay, use principles over time to accumulate wealth and to really have a greater chance to stay wealthy. Overreacting to shorter term price movement, it's dangerous. Now, James, did you ever do that? Oh, absolutely I did. Okay, absolutely. Look, when market volatility hits, it exposes people that have too much of a focus on short term. Okay, now, are there any questions with that before we look at some examples here? Now, yeah, now, one thing that I think is important, okay, Sam actually says, no chance I'm speculating on crude, zero. Well, so let's kind of go back to this. Speaking of stocks, I think it is interesting when you take a look at, let's say, energy itself. Now, remember what I said, okay? I want you to literally listen to what I said. And we talked about this on Friday with Kevin, crude oil, right? IXE is not crude oil. It's energy companies. And if you look in the last week, energy companies, stocks, it's kind of gone flat. Now, it didn't go down, but it's not the oil price or something that's trying to track it. So that's one thing to kind of notice, but you're right. If someone's saying, I'm going to speculate on the oil price, well, this is not the product, okay? Now, the biggest actually thing is, let's kind of talk about the second question from John. Dollar cost averaging equals more about how that applies in this context, please. Oh, we're going to get to that. So the one thing that happens is when the market actually goes up higher and higher, a lot of people sometimes on the beach, literally, they're scared to get back in the water. I'm going to tell you what I've learned. The higher the VIX, the better the potential entry on the index, on the sector, on the potential industry group, and maybe the stock. The higher the VIX, the potentially better. Now, you might say, you're out of your mind. How many of you would like to go back to buy in 07, 08, 09? How many of you would like to buy stocks in the Great Depression? You bought the index, something that tracks the index. How many of you would like to buy in 02, right? Well, what happened? The higher that the volatility was, the better the potential the setup was on the index, on the sector, on the industry group. Individual stocks, they're risky because you are trying to nail the one stock. And this is where the investor might say, look, I'm not going to try to nail the one stock. I'm going to try to buy the group. And that's very important to understand. Some of those groups can move like an individual stock. Do not forget that. Now, I want to go back to one just real quick. Let's kind of talk about this, okay? So when we look at a stock like Akamai, if we take a look at a stock like Akamai, what I always like to look for, and most investors are bullish, okay? Now, James, why don't you do a bunch of bearish trades? Well, because I think we're going to try to take trades where most of the classes I teach are kind of more bullish in nature. Do I teach about hedging and things like that? Yes. But a lot of times we tend to be more bullish investors than bearish, okay? Now, I do think it's interesting when the market falls, I like to evaluate which stocks haven't fallen that much. So if we actually had pulled up, let's say, a list of NASDAQ 100 stocks and said which stocks have pulled back the least on a 1 week percentage basis, one of the stocks that really hasn't gone down that much is really Akamai, okay? Now, we got to ask the question, why? Now, if we take a look at this, I want to kind of speak to this just real quick, okay? So if we have more volatility in the marketplace, okay? So question number one we got to ask ourselves is, how much do you put into a position on any given trade? Now, as I ask this question, you should have a number where you say, James, My number is $7,500, whatever it is. That $7,500 represents a dollar amount, of course. But if we said, look, the portfolio was $150,000, it's going to give us a percentage. Okay. Now this is tried and true. You go back and say, you go back to the principles. And those principles, if I said $7,500 is how much we're going to put in, $150,000 is the portfolio value, that gives us 5%. Okay. So we're talking about 5% of the portfolio. Now, when the market is more volatile, you're going to, and I've said this before, but let it echo again. When the market is more volatile, you tend to see multiple opportunities to get in. And the lower that the market goes, the more you say, dadgummit, I wish I had some money. But you shot the wad, so to say, of capital all on that one entry. So what some investors will do is they'll make not one entry, but they'll probably have 2 entries or 3 entries. So in other words, if we took this and actually said, set 2,500, 2,500, 2,500, split it up in three entries, we're going to try to buy some at the current price. Now, of course, as retail people, we would say, hey, look, I like to buy if it went lower. Well, that's what you say now, right? Isn't that what you said? You said, man, if it falls down, I like to get in before it falls down. But then it falls down, you're like, nah, I changed my mind. Wait, I thought you said before. Okay, so a lot of investors, when they really see it, what happens is if it goes to the upside, they're like, geez, now I'm going to buy more at a higher price? So what is it? The answer is maybe we'll take both in our examples, right? If we're saying, I want to buy above the trend line, we'd rather have the second comment, which I'll add to the position if we break to the upside. For the time's sake, what I'm going to do is I'm going to split this entry in half. We're going to take this, go the percent dollar amount there. We're going to take 37.50. If I had a little bit more time, we could do it in threes. And if you want to kind of do it in threes, go for it. What I'm going to do in this case, I'm going to take 37.50. 37.50 is actually going to be 36 shares of stock at the current stock price of 101.89. What I'm going to do is I'm going to put that target right up at 111.54. Now, remember what I'm just saying here. The market is about one press conference away of igniting, okay? The problem with what has actually happened on a geopolitical basis is that you run the risk of running a lot of economies into the beach of recession, okay? And a lot of times oil can do it. So it's like at the same time, the things have happened, but at the same time, you're not trying to run multiple countries into the ground by going into recession, okay? So the biggest actually thing is, like typical governments, they try to do both things, okay? Now, I'm going to take 111.42. I'll put it right that high. You might take a little higher or lower. I'm going to go dated GTC, okay? Stop dated GTC. Now, here's the deal. What a lot of investors try to do, they go all in or all out. And here it's about we're going half in and saying, if you go up more, I'm going to show you more capital. You have to prove yourself. That way, if, example given, and I'll show you this in just a second, if this trade does not work and we go lower down to this horizontal support area, I have more money, more capital to try to buy lower. Now, I know you're thinking like, well, if I go to the store and I see the steaks at Costco for $50, not $75, you might want to buy those steaks, right? But when the stock market goes down, all of a sudden you're like, I'm not really sure now. But as a consumer buying stuff at the store, it's fine. But in the world of investing, it just doesn't feel the same. But maybe could it be the same? Right? That's what we're trying to actually help you understand. If you split up the entries, you're going to have more options. You're going to dollar cost average. The moral of the story is stop thinking that you have to get in all at once. You're your own worst enemy. Okay? Now, we got target. We got the stop underneath. Now, what I'm going to do is I'm going to take this low right there. That's about $95, $96. I'm going to make sure that the stop, speaking of their own worst enemy, setting stops that are too tight is probably a trading hazard. If you're risking less than 3% of the stock price itself, you're probably setting stops too tight because those stocks on the average daily trading range probably move more than that. We don't want to set stops too tight. We want to try to allow it the trend to trend. So we're going to set that stop underneath 96, less 2%. That stop's going to be at 94.08. Now what I'm going to do, 94.08, okay, dated GTC, confirm send, and we actually see that order right there. Now, here's what we're going to do. We're going to take this position. We're going to say, look, and I'll just speak to it. We're going to say, where's the resistance? That resistance is at 102. I'm going to take the 102, resistance, and what we're going to do in this case is we're going to add 1% to that. It's going to give us about 103.20 or so. Check me on that. Adding 1%. That is going to be the buy stop price. We're going to use the same target, the same stop, and we're going to see if we can add. And how much capital are we going to invest? Well, we're in this case, for time's sake, we're going to take another $37.50 and we're going to try to allocate it. Now, wonder if it doesn't break out to the upside, but it breaks down. Well, it's going to be $37.50. That's going to allow the investor to buy more shares at the horizontal support level. Now, let me give you a classic example of what happened last week. There were some investors that thought last week, aha, I got a nice bounce entry on INTC. INTC goes up a little bit and you thought this is just too easy. Then all of a sudden last week, the market starts to drop and INTC goes down to the support level again. That's not completely unusual, okay? Especially if you have, let's say, volatility events. If the investor got in last week, they might try to use today as another opportunity to get in again, okay? So lesson number one is consider spreading the capital. On higher volatility, there's probably going to be multiple shots to consider bullish entries. If you put it all in, you're actually creating volatility on yourself because you've invested a higher amount of capital, okay? And with a higher amount of capital, you buy more shares. You buy more shares, you have a higher delta. Higher delta, greater volatility on the position and the portfolio. Type in the chat if you get it, okay? Now, what I want to do is also, I'm going to go, now, one of the questions was, why not use options? Now, well, one of the points that we need to go back and state, remember I said that stocks are not, people kind of think, well, just because they don't have expirations, they're not risky. Stocks are risky, okay? And stocks take the highest amount of capital. They can go all the way down to zero, and they absolutely can go to zero. I've seen them go to zero, okay? And so the biggest actually thing is, at least with options, the risk is, yes, they could go all the way down to zero, but they might have a defined risk, okay, that's not as low as the stock going down to zero, okay? So let's kind of, and that's a major point. In higher volatility, you might say, I'm not going to do as many stock positions. I might do bullish strategies that are, for example, trying to take advantage of trend, but have defined risk built in where the stock doesn't have to go down to zero to finally get to that defined risk. Example given. So if we were going to look at, let's say, a stock, I'm going to go back to a stock, and I'm going to use, or try to, a stock like T-Moose. And I'm going to look at a stock like T-Mobile, okay? Now, T-Mobile, what you're now going to notice is, if we said, well, what's the trend on T-Mobile been? Well, it's been in a downtrend if we're going back months. If we go back and look at, let's say, the recent levels, you're going to kind of take a look at this. We kind of have like a downward trend line. It broke the trend line. The breakout was right there. The retest was right there. If we said, where do you see the new support level in the short term? When I say short term, I'm talking about the last 2-3 days to 2-3 weeks. Where do you see it? I think most of us would say, James, I'm kind of seeing that little support level in the short term. You said 2 days to 2-3 weeks, probably right around that 212-ish. Now, if we said overhead resistance is where? That overhead resistance, if we looked at it, where we've had a couple tops above that, 225 or so. Anything above that would probably be in this area. Now, we got to ask ourselves a question. Why didn't they sell down T-Mobile? Why? Okay. Now, we talked about these some stocks that have been uncorrelated to the market. And I think one of the most fascinating tools that is just like people just maybe don't really take a look at it, they don't really know what it is showing, is looking at the correlation on the SPX or the correlation of the stock compared to the neighborhood of the industry group, etc. If we looked at the SPX, when the market is falling down, you might look for stocks that, for example, have more of a benign correlation. Now, if we said correlation of one means it's like a magnet. Whatever the stock is doing or the market is doing, the stock is doing, or the S&P 500. They're magnets. If we actually said, for example, let's say, and this is rolling 10 days, if we actually said there's zero, not a magnet, like one's going up, one's going down, they're different. If we actually said there's negative, now we're talking about, this is like oil and water, okay? Literally, where if the S&P is going up, T-Moose could be going down. Or if, in this case, T-Moose is going up, the market could be going down. Now, to get true negative correlation, that's pretty hard. To get true, like one correlation, that's really hard. The key is to probably get negative 0.75 or less, or 0.75 or higher. Not that it has to be there all the time, but if it's probably those levels, positive or negative, pretty positive correlation or negative correlation. Lately, so think about this. What has the market been doing? Down. What is actually the correlation of actually T-Mobile in the last, let's say, couple weeks? Negative. These are those stocks like the CRM, like the IBMs, etc., that can actually sometimes, when the market falls, they can go up because they haven't been correlated to the market. The stocks that have higher correlation, they tend to drop with the market because those are the ones that have the profits. Now, let's go back to this. If the investor said, well, James, I want to choose an option trade. Well, funny you should say that, okay? Now, if we take a look at this, I'm going to go back and type in T-Moose, okay? Now, if I were to look at T-Moose, and I'm going to go back to this, we're in the IRA account, and I'm going to imagine that I'm a stock investor. And I said to myself, you know what, James, I'd like to buy some shares, okay? I want to try to use the volatility, and I want to try to buy some shares. Now, you got to remember, in a higher volatility environment, VIX higher, the spreads and the options might be higher, okay? Now, option number one is, I'm going to come in here, and on this T-Moose here, I'm going to buy the shares of this. Now, by the way, we could do this with lower price stocks, and we'll do another one. I'm going to buy the shares. Step number two, I'm going to come in here, go for single order, first triggers SEQ. When we talk about, let's say, doing an option trade, if we're trying to go bullish, but have a max loss built into the trade, that's not where the stock goes to zero, the investor could buy the put. Now, how many of you would like to go back a week and say, James, I've heard you talk about buying puts, and you know, honestly, I've never really done it, but every time when the market goes down, I'm getting closer and closer to considering it. Well, if we buy, let's say, the $210 put, we've got a 425 bid, 480 ask. Well, if I click on that one, delta 30 to 40, we want to make sure that we're buying somewhere in the middle. Now, this spread is wider given probably higher volatility in the market. Noted. But that's why I want to make sure that we get closer, like we're getting in the middle, not buying at 480, okay? And just because we put 455, does that guarantee that we're going to get in at 455? Oh, no. Going to try to, though. Now, number two, well, that's the downside. This is what is creating. Now, guys and gals, you got to listen to this. The people that talk about, man, the market went down, I just got hammered. That's what they say, right? Well, they're the ones that don't have defined risk. They're the ones that don't have stops, okay? Now, the goal of some investors, you might say, and by the way, this is where most of us have been at one time. You might say, James, I'm accumulating a portfolio where I'm trying to make it where if I can, I would like to buy 100 shares of the stock or whatever the product that I'm buying. That way, if I wanted to put on protection, that stock is liquid, that there's options, and if I had 100 shares, I can protect it. That way, if all of a sudden out of the sky, different things come out in the marketplace, I at least have 100 shares that I can protect, and I just don't have to get out every time there's something. That's something that you probably work towards, okay? And you say the goal is that in the future, I like to have 100 shares minimum of everything if I'm buying it, and there's stock liquidity at that time, check in the future at that time, and also liquid options that if you said, I want to hold these during volatility, that is a higher potential chance that they could have liquid options. Just look no further than last week, okay? Now, what I'm going to do is a lot of people say, well, I don't want to pay for this. I made a comment last week, which is the investor probably could have just bought the put and offset what they had a drawdown on the stock with. So sometimes in a way you do kind of pay for it, but the investor sometimes they just don't like paying for the put, okay? Well, what we're going to try to do in this case is we're going to use the call to help pay for that put. Now, what I'm going to do is I'm going to kind of make it where 455 is barely above that bid price. So we're paying 455 trying to on the put. On the call, 455. Welcome to a zero cost collar. So really this has that capped upside, and the risk profile really looks like a vertical spread. Has a higher max gain, higher invested amount, but also has a built-in max loss. So your comment on, let's say, callers, this is the example. Now, a lot of times, now with these callers, it doesn't have to be all at once. We talked about that, right? So I want to go back in this case. Now notice the commission on that to sell the call and buy the put. Note that. Let's imagine you said, James, I want to go back to, let's say, a stock that's also been going up as well. And now example given, Devon, DVN. Now, wonder if you said, James, I want to learn this, but I want to learn it on a lower dollar stock. Okay, fine. Well, let's kind of say, okay, we see Devon here, and notice Devon kind of, it's been up, had a pullback, kind of see a little on the right-hand side, maybe trying to get a little push to the upside. Now, if we go to the trade tab, we cannot assume that there's liquidity. We got to check with our own two eyes. 2.8 million shares so far traded today. On the calls of the puts, what do we got? I'm just looking at the money, out of the money right here. On the 47.5, about 18 cents wide. Over here, about 18 cents wide. We would like that bid-ask spread to be narrower than 20 cents. On T-Mobile, it was wider than that. That's why we had to kind of chisel down on the bid-ask spread. But it's probably harder to get a fill. If the bid-ask spread is narrower than 20 cents, and it's trading more volume, etc., and the open interest is higher, probably a greater chance to get filled, okay, compared to T-Mobile. Now, let's do the same thing. How do we do it again? Quickly. Click on the ask price. Step number 1, buying the shares. Buying the underlying asset, the shares. Step 2, single order, first triggers SEQ. And then we're going to come down and say, okay, the put side, okay? Now, on the put side, if we said, well, which put? Well, we're looking at this example of delta 30 to 40. Delta 30, 40 is the 42.5. So we're trying to trade the technical direction of the stock, but we're saying, look, if the stock goes down, I want that risk, defined risk, built in. By buying the put, it gives us the right to sell those shares at 42.5. That way, if this stock goes down, I don't have to say, oh my gosh, I can't believe I'm down $10 a share and I'm losing $1,000 on 100 shares. The put is offsetting a good majority of that. I'll show you a quick example. Now what you're going to see in this case is if I now come over here to the call side and sell the call, there's your classic buy the shares, write the call or sell it, and buy the put, okay? You are bullish. It's just you're capped. You're saying to anyone in the open market, you can buy my shares at 47.5. Just bring your money if you're going to buy it. Okay. So you get from 45 and change up to 47.5. Okay. And if we take a look at this, if we go confirm and send, we're going to send the order. Okay. Now, notice that again, the commission is to sell the call and buy the put. Now, let me kind of show you what I mean by this. Okay. In the last, let's say, week or so, the financials, some of them, they have not been that strong. Example given, if you look at the IXM, you'll see that financial sector has been under severe pressure. But why do I pull it up? Well, the example given as a follow-through is if you look at WFC Wells Fargo, that has not been a beautiful trend. So let's say that I was Rachel and I had gone to these different areas for vacation, whatever. And I had the position of Wells Fargo, but I put on protection on Wells Fargo while we were gone. Now, if we look at this position, if we pull this up, Wells Fargo, if you pull this up, there's the shares of the stock. Noted. You're going to note that the shares of the stock were purchased at 87.5, and now it's at 77. And that doesn't take too much explaining. You're down $10 a share. You got 100 shares, and so you're down $1,000. Probably know that. But remember, the call and the put, those are bearish options, meaning they could benefit if the stock was going to go down. Now, you're going to see, we said this, that if both the short call and the long put have made money, what does that tell us about the direction of the stock? Oh, okay. It tells us that the stock has gone down. If the short call and the long put are both up and the stock is down, well, we didn't lose $1,000 total. It was $400. Now you got to ask yourself, okay, I won't force anyone to do anything. Okay. Would you rather be down $400 or down $1,000? Just up to you. Okay. Now, I don't think anyone wants to be down anything at all. But if you said, I'd rather be down 400 or 1,000, I think most people would say, I'll take that 400. Okay. So the biggest thing is really about this is when you have that volatility, if you had 100 shares, okay, could you call out the position? Sure. Consider. You have to actually check the liquidity, but you could try. Okay. So that's number one. Number two is if you had less than 100 shares, probably more than 40, could you try to add the long put? You could try. You have to check liquidity. That's why buying stocks or whatever you're buying that has liquidity is key, because when that volatility hits, if you said I consider options, if you do not have stock liquidity, then what's the chance you're going to have option liquidity? The answer is probably not that high. When I say stock liquidity, what am I talking about? I am talking about 7 figures. I am talking about millions of shares traded a day. All right. Now, the comment from James L says, what cost of put and call versus total loss? Well, on that example, let's go back to just this real quick. So if we pulled up that, no. Let me I'm going to bring back up that last trade example. So I want to just bring this up. Just trying to actually get that back. DBN, that was correct, right? DBN. Now, if I pulled up, DBN. So let me just put that back because James had a question on it, okay? So let me put it back up, and I'm going to kind of show you those numbers. So if I look at this right here, that's what it was. If we looked at this, and I'm going to say probably more realistically, and said 47.5, okay? That's $1.45. That's the bid price, James, right there. If we look at the 42.5, I'm taking the full ask price. Could we try to chisel that down to maybe $1.40? Sure. Okay. But let's just say it's a $1.45 call, $1.45 put. So when you take a look at that and we say, okay, what do we got? It's a zero cost collar. What does that really even mean? Well, it actually means that we don't have to add or subtract from the max gain or loss. Now, when you take a look at this, we're going to put this on the Analyze tab so we can answer fully James's question. Now, first off, when you take a look at this page, we now see that the position, there's our shares of stock down here at the bottom, check. There's our short call, check. That's why that line's right there. And you're going to see there's the long put right there at the bottom, and that's why that line goes flat. So if we said on this trade, if the stock went down, what's the potential max loss? If we did the basic math, it's probably what, $265. If the stock went up to the upside, how high could it get? North of 200-ish, okay? And so that's how we can see that. All right, yeah. Look, so here's the deal. It still allows the investors to take bullish shots, but they're bullish up to a point, okay? Now, what I'm going to do is I'm going to go back to this just real quick. So I just wanted to answer that question. The other one I kind of want to pull up just real quick that's kind of shown some bullishness. Now, a stock like CrowdStrike, okay? So what does CrowdStrike do? Does anybody know? Now, consider what's been happening geopolitically out there, okay? CrowdStrike, if we take a look at this, if we go to Analyze, there's two stocks I want to focus on in less than 4 minutes. When we take a look at this, the fundamentals, if we go to Analyze, fundamentals, they actually do cloud delivered protection of endpoints, and it's cloud protection, okay? And so what you're going to see is they do threat intelligence, okay, and security, okay? So kind of given the situation that the world has been in the last couple of weeks, et cetera, some investors might be thinking, geez, it's kind of maybe, could it be getting a little reversal? Now, let's say the investor said, I don't want to buy the shares. But I'm thinking that maybe the stock might be trying to go to the upside. Diagonal resistance actually break there. Longer term diagonal, we might be getting above it. I'm going to go a little bit lower because I think we get more points there. Okay? And if you look at that, that might be one that's actually, now if you said, well, geez, has it gone down? It hasn't gone down. Even with the market actually going down, probably tells us something about correlation. Now in this trade example, what we're going to do is we're going to do a short put vertical. Now with that short put vertical, what I'm going to do here is I'm going to bring this up to that. Now if we did a short put vertical, that actually means that we're not buying the shares of stock. Now, if you look at the short put vertical, it's a higher price dollar stock. Spreads are showing a little wider here. Now, I'm going to show an example of, wonder if I said, hey, I want to take a bullish trade, but I want to go farther out of the money. Well, if I went farther out of the money, given wider spreads, okay, we talked about that, higher VIX, higher option spreads. If I chose example given like a 25 delta, 25% chance as of right now, the stock would be a penny below the strike price. Well, you got dollar wide spread. We want to make sure, okay, that actually if we put this in the middle, that we're trying to get the mid prices of these options. Well, this is the 390, the 380. Well, if we look at this, it's a 237 credit. Well, $10 wide spread, okay, and a 237 credit, you have a maximum profit less than max loss. It must be a probability type trade. Now, volatility, if you look at this, this is where the stock price is now. This is where the break even is as of today. No, not today. At expiration. And so what you're now going to notice is that's $40. Now, it sounds like a lot until one day it goes down. So if you take a look at this, we have a $40 buffer. That doesn't mean it can't lose money, but we have a $40 break even, where the stock investor, their break even, if they bought once, is what they bought the stock for. Here on this type of strategy, there's some built-in buffer. Now, as the stock drops, it doesn't mean it can't be losing some money on the way down there. But we're trying to actually have some buffer that's over time, okay? And also we're trying to get time decay to go by and the volatility to contract. Now, I'm going to show one more. I'm not going to do the trade, but I want to kind of just point this out. The one that was brought up last week was RTX. RTX, if we looked at this, and many of you said this one, all right, Lockheed Martin, Northrop Grumman, NOC, LMT, RTX, and so on. This is another one we have to look at it and say, did it go up to brand new highs? Like, well, no, nothing did outside the VIX, okay? But the biggest actually thing is, this is another one I think some investors might keep an eye on to see if there might continue to be a focus by governments, okay, that if they continue to put a higher and higher percent to defense, okay, and companies like this might get those contracts. So keep that in mind there. So I'm out of my time here today. We try to kind of walk through some investing principles that tend to be a lot more likely to work longer term than just short-term volatility, which doesn't tend to last all the time, okay? And also remember that we have Cameron May coming up next at the top of the hour. Thanks to Rachel Dashwell for answering those questions in the chat, and thanks to all of you. We did a number of trade examples and kind of talking about some stocks we could look at, strategies to consider given the backdrop. I'll be back on tomorrow morning, and feel free to also join Rachel in her class tomorrow. She'll be teaching tomorrow as well. So thanks to all of you, and this has been the class on trading with technical indicators. Stay tuned for Cameron May coming up next, and don't forget to subscribe. Take care. Bye-bye.